So Michael, thanks for taking the time to meet with me today.
My pleasure, Rafael.
Great, great. So you've written this book, The Upside of Risk. Tell me about the book. There's a lot of books that are out there that are talking about risk management. So how is this different and what prompted you to write it?
Well, what prompted me to write it is, while there is a lot of literature out there regarding enterprise risk management, the challenge is it's highly inaccessible to most people. They view risk management as some type of compliance task, and the traditional literature about risk management is very academically oriented, and you get into things like the COSO framework, and it's hard to get practical application. And most people think of risk in a very negative way as something they want to avoid, but by applying the appropriate measures, we can actually use it as a competitive advantage. And being able to access that aspect of risk really wasn't out there. And for a lot of financial service companies, banks, credit unions, mortgage companies, they really need to understand how they can embrace risk and how that creates a competitive advantage for them. And so this book is designed to try and show them how they can do that. So Rafael, what did you think of The Upside of Risk?
I thought it was a very easy read. I enjoyed reading it. Again, I've read a number of different books in terms of risk management and strategic planning, and they get very convoluted. What impressed me more is the fact that not just as you as my employer, but you as the founder of this company, understanding risk management so easily and genuinely, where you describe it as fun and where you and I can spend all day in discussions about risk management, and yet you brought this together in a book that is not overly complex. You start by giving really good examples and moving to the more complex, and then demonstrating how those KRIs, key risk indicators and key performance indicators, can be used by institutions and giving and showing a system without kind of giving away the secret sauce of your products, but saying, here's how it helps. So for me as a regulator, I looked at all these books and also teaching bank directors, any of these that I found helpful. And this was extremely easy for me to digest within the first week that I was onboarded here and started reading it. Like, this all makes sense. I like the way it's done, but again, I have to say what impressed me more as the founder of the company, it's not just some outsider that's coming in. I see an opportunity here to create a company that's going to cater to financial services. You get it. Where I see really the linkage and what I liked what you highlight in the book is strategic planning. Can you talk about strategic planning and how that fits into the risk management framework?
Right. Well, so strategic planning is an integral part of enterprise risk management. And unfortunately, most people have a pretty poor strategic plan, where they view strategic planning as a budget exercise instead of a long-term goals in what they're trying to accomplish. And again, there's a lot of literature out there, but what makes the financial services industry different is all of those risks can be taken into account as part of that strategic effort. So we think about the concept of what's our strategy as kind of a high level, and people can articulate that. But what makes a strategy different from a strategic plan are the milestones along the way and the path we're going to use to get there. And we have to keep risks in mind while we're executing against that strategic plan to ensure that we get to that destination.
So when you're talking about strategic planning and the risks associated with that, one of the downfalls that I saw with banks is that they were really not looking at a strategic plan, they were being tactical. Is that something that you saw and that you've noticed in your career?
Yes, unfortunately, far too many financial institutions view their strategic planning activities as, let's go do what the big banks are doing. Let's follow the other people. And so, wow, we really need to be more digitally oriented. Why? Because every other bank's becoming more digitally oriented. And that's not really a great strategy, just to follow what other people do, even though there might be a lot of similarities from town to town or state to state or region to region that we can take best practices from. But again, your strategy is more about envisioning where do you want to go, not just where are other people going.
So again, a minute ago you were talking about the model on which it's based. Can you talk a little bit about the model and why you chose that framework?
So the model for enterprise risk management isn't just created in a vacuum for best practices from some agency like COSO or other standards that are out there. But the regulators have actually talked about the need for enterprise risk management, both to allow banks to operate in a very healthy way, or credit unions, or even mortgage companies for that matter, but to get to those successful outcomes while balancing risk to ensure they get where they want to go. And so we have to take that regulatory framework, not in the notion of I want to check the box to show a regulator I just complied, but rather take it into account because there are some best practices out there in this industry that we can then leverage to balance the risk and reward and create a mindset that permeates not just from the executive team, but all the way through the culture of the entire organization to make sure everybody's operating on the same page and to avoid these scandals that of course show up in the news where people wonder how could any financial institution ever let these types of things happen.
Right. You touched on a subject that I've talked a lot about in my training and outreach to bank directors, culture. Talk a little bit about that and what impact you see it has upon an organization.
So culture is absolutely fundamentally key for compliance, risk management, but it's also key to accomplish your goals for profitability, growth. And when the culture at the financial institution is cutthroat, meaning we only care about the bottom line, we only care about how much fee income we can get from customers, and that's all that matters, it shows in the institution's culture and the way they interact with customers, and that filters all the way to that front line. I'm talking about tellers, loan officers. And when those tellers and loan officers care deeply about the client or member, they're also going to be far more attuned to compliance, privacy, all of the standards you want. So if we think about it where I'm giving a loan to a family member, how would I want my family member to be treated? And that's the tone set at the top. That will show up within the financial institution as well.
So going back to the CUSO model, I think the model that they talk about on the 3 lines of defense, let's talk about that.
Sure. So the 3 lines of defense are designed to help protect everybody. And so at the first line, we have the operational risk. A lot of people call that the doers. So these are the people most people or clients, members, prospective clients would interact with and your daily operations. And so they're what we might call the execution phase, where they're taking in the paperwork, they're talking with our clients. Then we have the second line of defense, which are managers, and the second line will change slightly based on the size of the organization, but they're the ones that are setting out the procedures for how we're going to execute against whatever those rules and overall guidelines are. And I am going bottom up here. And so then you have that third line of defense, which is to verify that the managers are creating the appropriate rules and following the policies with their procedures, and that the front line's doing what they're supposed to do in their interactions with clients and members and things of that nature. And when they work together really well, you wind up with, did we set the appropriate rules? Did we execute against them? And are we testing to make sure that that's working appropriately? And with all of that data, the board and senior management can then understand what resources do we need to add to make things better or worse. And my favorite examples are kind of information technology examples, because we think about things like a firewall or antivirus. These are all things you might even know from just using a laptop these days, which most people use. How often do you want to update that? How often do you want to make sure that your endpoint security is really working? What I mean by that's like antivirus software. Is that something you want to check daily? Is that something you want to check weekly, monthly, or annually? And the number of catastrophes from an information technology standpoint, where if you went back and look at the standards, they set the standard to look at it annually. Like the only thing that matters was getting ready for an audit or an examiner or a review. that's when you wind up with really big problems from an information security standpoint. And most people want to check on things a lot more frequently than that. And that's where senior management, the executive team, and the board can make sure they're properly resourced so those controls, which are absolutely vital to your information security, have enough resources so you can get that feedback loop and really understand that you've got the appropriate measures.
So Michael, what are some of the limitations of risk assessments?
So risk assessments can be limited based on the scope size of the risks as well as the controls. And it needs to be right-sized for each institution in each organization, because you can get lost in what are all the risks that could possibly happen. And just think from a personal perspective. You get out of bed in the morning. What are all the risks that could possibly happen? What are all the risks that could possibly happen on my commute to work? Even if the commute to work is just walking down the hall, all the things that could go wrong. And all of a sudden you can get lost in lots and lots of negative thoughts. And so the idea behind a good risk assessment would be to understand categories of risk and what controls can we put in to mitigate them. But every individual is a risk manager on some level. And when we think about it at the organizational level, we need to keep that in mind, because I've seen far too many financial institutions really get lost in that first exercise and over-rotate on risks, where they start with things like, I want to do a risk assessment on a item-by-item basis or inventory, which again, in traditional 1980s, 70s, how many laptops, computers I have might make a lot more sense. How many door locks do I have? How many alarm systems? But if you start taking that principle and try to modernize that into risk and all the risk that can be there, you just get lost in inventory. So that's the first sign of a good risk assessment is, do I have the right risks identified? And then once I've done that, do I have the appropriate controls to help mitigate those risks? And then the third step would be, what's the frequency of measurement for each of those controls so I can make sure that we're on that right path for my strategic planning?
In Chapter 4, when you're talking about risk assessments, I think you really did a good job, because you used a lot of adjectives to describe risk assessments. You talked about thoughtful risk assessments, you thought of smart risk assessments, and well-executed risk assessments. Talk a little bit about that.
So the concept of a good risk assessment means they've got the appropriate risks and controls mapped. And a lot of people do that, and you can do that in Excel, and that's great. But then the next step to evolve it to a smart risk assessment would be one where we're getting that continual feedback and adjusting as we go based on the information we're collecting. So if you do risk assessments once a year, and that's all you can have time to do, and no behavior changes as a result of your risk assessment, you have to start thinking, are we really doing this appropriately or not? And then if you want to take it a step further beyond just changing potentially controls and behaviors, is it really being communicated all the way through to the board level, and how's it impacting our strategic planning as we move forward? And my favorite way to kind of explain that is to really use examples, because it's really easy to talk about it at a super high level and it makes sense, but then let's put that in practice. So one of the more common strategic objectives right now is, how do we increase our digital presence at our financial institution? And the whole world seems to be using phones for everything. So that's important to us. We want to do online account opening. We want to do these things. Well, the first question is why? And that's, you got to start there. We want to do that, and what are we trying to accomplish by providing these additional means? Do we need a younger demographic within our institution that we're trying to attract? Do our current clients even want to interact with us in this way? Those things need to be thought through at the strategic planning level. Once we've figured that out and what our goals are, then we can get into, okay, what are the risks in having these new systems where we may add a client or a member that we've never met before. They're not physically walking in, they're just doing it on their phone. And once I've got those risks identified, then I can say, well, what are my controls to make sure they are who they say they are? I've got all the information I need to open an account, for example. And then how often are we going to measure to make sure those controls are working? and then you can go from there. So
we're natural risk managers. So why do we look at something that we do as part of our daily life and how we approach life and approach others? Why do we see it so formulaic in an institution and find that it's hard to wrap our head around, whether it's enterprise risk management or just the whole idea of evaluating risk?
Well, people view risk in different lights. And the human behavior element, which is really the big mystery in how we handle risk. So let's take that and break that down in a couple of different ways. So a lot of people will use their own experience rather than data to make a risk calculation. And that risk calculation can go from things as controversial right now as should I get a vaccine for COVID-19 to should I go and buy a cup of coffee at Starbucks, to should I buy a house, refinance my house. All of those people are making natural risk assessments about. And typically, if you bought a cup of coffee at Starbucks every day, your view of the risk in doing that's really low because you do it every day. So your own empirical data tells you that's a very low risk activity because you've been there and done that before. However, there are lots of studies that are fascinating about human behavior. One of the controversies way back in the 1950s and 60s was this controversy regarding should we require people to wear seatbelts? And as we think about wearing seatbelts, one of the arguments was, well, if everybody wore a seatbelt, everybody's going to drive faster because they feel safer in their automobiles, and therefore the wrecks would be even worse. So if we start applying that kind of logic, as we do some things to make us feel safer, well, we may feel too safe and we want to take even more risk. So I've got an enterprise risk assessment in place. Well, with this great enterprise risk assessment and all these people I've hired to help me manage risk, well, now we can do all sorts of high risk lending. It doesn't really work that way, as you can imagine. And so we need to kind of balance and be thoughtful about how we're taking in information, how we're then applying that information in the control data that we use. So we're not doing, well, I've never been written up by examiners before, therefore I have no risk. It doesn't really work that way. Just like I go to the store for a cup of coffee every day, and that's not no risk in doing that. There is a risk. I could still get hit by a bus while I walk across the street or whatever those things are. And it's another analogy would be, I've never been in a car wreck before. That does not mean you can't be in a car wreck. But try telling that to a 16 or 17-year-old or 18-year-old driver, you understand where that can go horribly wrong.
We do this naturally every day, but we fail to incorporate those same things when we come to business.
Right. And well, unfortunately, people incorporate those same biases when it comes to business. So if in their personal lives, they're taking risks because they've never had a problem before, they tend to do the same thing in business because it's an unseen, and therefore it's not something I really have to worry about, therefore the risk isn't real. And that's just a pretty myopic way of looking at the world. One thing that separates the great enterprises from those that don't make it are their ability to take all that outside data and not just their personal experience and incorporate that into their own risk management.
You talk about accountability in the book, and you give a really good example about the lack of accountability. Let's talk about accountability and why that is so important in terms of risk management.
Right, so it really goes back to that other topic, culture. So when we have a culture of accountability, everybody's a risk manager, which we already established, and everybody's responsible for making sure these controls take place because they understand the risks at stake and they understand how it impacts the overall strategic enterprise. And when you wind up with that as your culture, you wind up with a great enterprise as you move forward because everybody understands what's at stake when we don't do something or we do something the right way. So lots of examples, but I'll pick on a vendor management example. Oh, that vendor really doesn't matter because it's a marketing vendor. And even though they're going to take in all the data from our financial institution to figure out what products and services they could market to other people, it's not really critical to our enterprise because we could replace them with somebody else. But if they lost all our data, which has happened, all of a sudden we have a critical problem. And now I've jeopardized the entirety of the institution because I really wasn't thinking about risk the right way when I onboarded this vendor. I was thinking about it purely from a business continuity concept instead of thinking about it from an information risk standpoint. And when we're good risk managers, we have to think about all those dimensions of risk and not be myopically focused on just one.
Again, vendor management, let's go with that topic. There's a lot of issues and concerns about what's out there, but it is highly important for our financial institutions because there's a value proposition of trust, and especially trust with the data that we have. So when we're looking at vendor management, where do people get bogged down?
Well, the first place they get bogged down is they just don't have the right policies and procedures in place from a governance standpoint, because the senior management and board need to really understand by moving everything to the cloud, information security risk is one of the biggest risks financial institutions face, and it can be life-threatening if they get it wrong, both to their reputation, the costs, and just the regulatory implications. Not that the regulators are police per se, but there are statutes both at the state and federal level that can make this incredibly costly financially. But we also just want to protect the people we work with and that are relying on us to deliver these products and services. So that's a piece of the puzzle that we need to kind of incorporate at the policy level. Then once we get the right policy in place and we understand what's going on, how do we implement the appropriate controls to help mitigate those risks with our vendors, whether we're using third parties or just internal resources to help us mitigate that risk, and then monitor that on an ongoing basis. I think for many financial institutions, they don't realize all the information that's available out there on these vendors that they could use to help make better decisions.
You give a good example about evaluating inherent risk, and use the example of your house catching on fire. Let's talk about inherent risk and how that plays into it, and where do banks or financial institutions miss the boat on that?
So inherent risk, let's start with what does that even mean? So inherent risk is what's the risk inherent to the activity, regardless of any controls that are in place. And so where I see this most commonly misapplied is my inherent risk is low because everybody uses this vendor, or my inherent risk is low because everybody else is doing it, which goes back to kind of the old child adage of, well, everybody's jumping off the cliff, therefore it must be safe. No, it's still not safe no matter how many people might do it. So we need to think about, well, what's the inherent activity, and then how do we mitigate that with controls that we can put in place to make sure we're going to operate in a safe and sound manner and be able to, again, back to hit that strategic plan. And so we want to put the inherent risk in place so we can mitigate it. So if I've got my house and I'm worried about it catching on fire, I can do some things to make sure. I can put a sprinkler system in. That would be a control that we could use. Then I might need to test the sprinkler system to make sure it still works on a periodic basis. And now I've got a good control in place if I'm worried about fire in my house. And so but no matter what, if I have a house that's flammable, I have a risk of fire. No matter what I do, that's an inherent risk. Now my only questions are, how do I mitigate that risk? And unfortunately, for many financial organizations, the way they mitigate the risk is they buy insurance and they'll let the entire house burn down with the notion, well, I could always rebuild it. And that is a way of managing risk, don't get me wrong, but it's a pretty costly way of managing risk because there's a lot of pain that's going to happen if your house burns down and you have to rebuild it. The financial aspect of it's just one aspect of it. And again, it goes back to, well, how am I going to hit that strategic plan if I don't have a house?
You talked about, I think it's a great example when you talk about mitigating those risks in terms of what we face daily in our lives, like the possibility of a fire in our house. And yet, that's the upside of risk.
Right. The upside is, how do I manage it in an effective way to get to my strategic goal? If all I did was obsess in my house about the risk of fire, I'm probably not going to be very successful in my career, my relationships, because I'm just sitting at home worried about fire risk all the time. And so that can be a very unhealthy way to mitigate risk. Just like it's unhealthy to just think about all the risks that could possibly happen if I get out of bed. I may never get out of bed because there's so many things that could possibly happen. So we want to put risk management in the appropriate place, and we want to do it in a thoughtful way, and that's what strategic risk management is, so we can get where we want to go. And that's the upside of risk management, is making sure we get to that point. But there's a reason. Some banks become mega banks. Some mega banks become the biggest banks in the world because they're good at doing strategic planning, and they're good at incorporating risk management into those strategic plans.
So financial institutions are facing a lot of headwinds. There's challenges in terms of how they're going to measure, monitor, and identify these challenges. What do you say to a person that, is like, you know what, we have events like COVID, and COVID just threw everything up in the air. So what do I do now? And yet, how did you see the impact of COVID upon financial institutions and how they dealt with it?
So COVID, like any other kind of, how can I put it, historic event, causes people to have to rethink their strategic plans, causes people to have to redo their risk assessments, and it can be a great time to experience real strategic planning and taking advantage of those risks. So we can't go back to the office, everybody has to work remotely. Okay, well, what are the benefits of that? And what can we do to reorganize around that and think about it from a longer term planning standpoint? We may never have everybody come back to work. What does that mean for us as an organization? Can we expand faster geographically if everything's going to be digital now? All of those are factors that go into it. And no, you can't plan for every scenario. I don't think most people had planned in 2020 that we would have COVID. And if they did, well, they are probably incredibly wealthy, because I don't know how anybody could possibly predict things like COVID. So, but by having the strategic framework in place, it gives you a process to go through to take that event and then map to it. With no process in place, now you have a double whammy. You have something that's disrupted your normal operation of business, and you have no framework to then adjust your plan, and you're trying to create a plan from scratch. At the same time, you're dealing with a lot of uncertainties and unknowns like COVID. And I think we'll see some institutions thrive as we, again, continue to recover out of COVID, and others that really flounder as a result of their lack of strategic planning capabilities.
So you bring up a good topic about banks. There's been a lot of consolidation in the financial services industry. I think there's going to be, sadly, continue to be more. But I think the missing piece is where some financial institutions don't understand how the upside of risk, how them putting in appropriate processes and systems helps their multiple of sales when they're looking at going to sales. So can you talk about that?
Yeah, so a good risk management actually dramatically increases the enterprise value at a financial institution, because all of those risks or costs that you may not have thought through or been unintentional about can create massive costs that come right off the purchase price. And that can be everything from bad vendor management, and you've got all these tail fees that are due to people even if you stop using their service, to leases, the list of things that could be costs go on and on and on, that if we're not managing them well. But typically, people want to buy a growing enterprise. It's worth more. And so if you're growing and hitting your strategic objectives, you're going to be in much better shape to demand a much higher valuation as you move forward. And that's why these financial institutions should be able to continue to thrive as they move forward. And let's talk about that for just a second, the whole fintech first financial institution, because financial institutions have a great competitive advantage. They're in a highly regulated industry. They're good at managing this highly regulated industry, and they can help technology firms with their knowledge of risks and compliance and controls. And by having that great framework in place, they can leverage that to help distribute technology. And they don't have to be experts in all things technology. They're already experts at managing risk, because that's what most financial institutions are best at. And when we can apply that logic to operational risk as well as financial risk and merge that together into a strategic plan, that's when banks just thrive.
Well, we're seeing a lot of partnerships with fintechs that, financial institutions were afraid that fintechs were going to come in and cannibalize the industry, and you see a lot of partnerships. Let's talk about the strength that banks have and the weaknesses with those partnerships and the value proposition that banks have, especially with vendor management.
So those partnerships can be absolutely vital to both the fintech and the financial institution. The financial institution is typically better at risk management, whether it's a bank or credit union. Both can partner with fintechs very effectively to improve the client or member experience respectively. But in doing that, again, it's all about strategic planning. What are we trying to accomplish? What's good? What's great? How do we get there? What are the risks involved? That needs to be thought through. The added complication, Rafael, that you mentioned was the vendor management aspect. All of a sudden, all that fintech's infrastructure becomes infrastructure that's critical to your organization, because you're exposing typically a lot of client data. And so where are they hosted? What security do they use? How often do they monitor those controls become highly relevant, and you better be prepared with resources to take that seriously as if it's your own infrastructure to make sure our clients' members are protected.
So what's your response to, these data breaches? They seem to be happening every day, and I've heard actually some people talking like, well, it's happening all the time. There's not a whole lot they can do. It's just not a matter of if, it's when. But the preparation that needs to be involved before when happens. Let's talk about that.
Sure. So first of all, just because there's a lot of data breaches out there doesn't mean that that's not a serious risk, and it also doesn't absolve us of liability and responsibility in our communities to help protect that data and prevent things like identity theft. So we want to put the appropriate measures in place. But then going back to good strategic planning, that's incident management. So if I did leak some data by accident or through no fault of mine, but a vendor did it and ultimately I'm responsible for it, at that point I need to have my plan in place of how I'm going to remediate that and what can I put in place to do that so we're well prepared. So if it did happen, or for the pessimist who says it's just a matter of when, great, I've got a plan in place of what we're going to do to help mitigate that risk as best we can for those individuals affected. But what you don't want to do is be lackadaisical about it and find out, well, we have a server, nobody even put a password on and all the data's there. And those types of incidents that unfortunately happen are very poor risk management because the costs are extraordinary and you don't want to just take that type of data for granted.
So we talked about this earlier in terms of the moat around the banking industry. And yet I hear bankers continually complain, why do I have to do this? And that kind of speaks to the why. Can you talk about that?
Yeah, so the why is because we in America have drawn a line around financial information and how it needs to be protected to protect your financial well-being. And part of that's because the government insures all these financial institutions, and there's a level of credibility that comes with a financial institution that unfortunately a lot of people are finding out the hard way when they work with a fintech that isn't backed by a financial institution but has familiar trappings like an account. And then all of a sudden that account doesn't have your money in it and you're wondering, well, what happened? Well, it wasn't a bank. It wasn't even backed by a bank. And so your level of ability to reclaim those funds and all the statutory protections that come with that, very, very low. And so before you just think of, well, it's an account like a stored value card, that's a very different thing than an account at a financial institution. And I think financial institutions need to do a better job of marketing all of that so that people have confidence in why they want to use our highly regulated industry, because it creates a safety and soundness barrier around one's financial well-being. And I don't think many people in the public fully understand or grasp the differences there. And so that's a real effort for banks and credit unions to get the word out about why financial institutions are different when they partner with fintechs than fintechs are on their own.
So let's switch gears now and talk about the company you built with Ncontracts. What prompted you to build the company? We started with talking about the upside of risk, and I really see just a great tie-in, and I appreciate now working for you in terms of you understand risk management. So let's talk about the evolution of how you saw risk management and the evolution of the company.
So I practiced law for 9 years before I started Ncontracts, and during my legal practice, I was lucky to be exposed both to fintechs and financial institutions. And most of the fintechs and financial institutions were managing risk through an Excel spreadsheet and as a compliance activity, which is not at all how any of it was intended. And to make matters more acute, because when I started the company, knowing that was a problem, it was even more of a problem when it came to third-party risk management. And as more and more institutions were adopting cloud-based solutions, back 12 years ago when I started Ncontracts, that was still relatively new. That wave was coming. And the regulators were well aware of that and the risks involved in that. And they were just starting to put out new guidance to help protect consumers and saw a real opportunity for providing software as a service to help manage third-party risk. But our twist was it was software with a service with an extra S for services, because we could help especially smaller financial institutions at the time when I first started with doing that additional due diligence work because they didn't have anybody on staff to do it. And so we've now built wonderful technology to help monitor these vendors on an ongoing basis and evolve that. So the company started in 2009 and really just focused on third-party risk management. In 2015, we got to evolve it. We were doing so well that we got outside interest from growth equity partners, and with that capital, we were able to expand into enterprise risk management, which includes things like business continuity management, risk assessments for every type of risk you could imagine, findings management, compliance management, audit, third-party, third line of defense reviews for quality of those reviews, so that it's a full GRC suite. But we're really unique in that we're focused on the financial services industry. So we have deep levels of expertise in things like fair lending and HMDA and CRA, and are able to incorporate that into the overall enterprise risk management platform because we're dedicated to this industry, so we can build content into the system and really leverage that. I think that's why we're growing so quickly.
That kind of strategic decision, let's talk about that a little bit more because I think it's so important. There's a lot of opportunities out there, but you have chosen to stay within the financial services industry. Why? Why is that so important for you?
Well, from my perspective, that was part of our original strategic plan, that we could get greater growth by focusing on this industry than we would by spreading our resources so thinly and trying to be everything to everyone, which would include retail, medical companies, the list goes on and on and on. And by having that focus, it really creates a strategic and competitive advantage because most of the other options in the marketplace are horizontally focused, meaning they're trying to build an enterprise risk management system for everybody. And you've got to bring your own data to the party. Well, anybody who's been through one of those implementations knows that's a multi-year potentially project where our clients can be up and running in weeks, not months or years. And that really gives them the ability to get the benefits from strategic risk management much more quickly. And I would even contend that smaller institutions need that level of speed to get the realization from their investment. And That's what we're bringing. But as we continue to grow and evolve, even larger financial institutions now are seeing the benefits of having all this data in one place where it's pre-linked together, so I can have that control data in their system one time, and it shows up in multiple viewpoints to create efficiencies and really help guide the process.
For many institutions, they're looking at vendor management maybe once a year.
Sure.
And yet you're constantly evaluating this for a number of institutions daily. So the benefit really is being able to see those nuances and those connections that if you're only looking at it one time a year, you don't get or you miss.
Exactly. So with 280 employees, 3,700 clients, our resources and ability to deep dive into this is vast.
Long-term strategic planning. So let's talk about the future. What do you see in terms of the future? What are your concerns, and yet what do you see as those opportunities?
So from a concern standpoint, obviously things like COVID come to mind, inflation comes to mind, the political environment are all external factors we have no control over, but we certainly want to incorporate those external factors into our thought process. From an opportunity standpoint, the information systems within financial institutions continue to present material problems because it's not integrated together. And so there's great opportunities to continue to integrate that control data into our systems to help with better decisioning and better outcomes. And so we see an incredibly bright future for our company as we're able to provide even greater services, both from a technology standpoint as well as a services standpoint as we move forward.
I think one of the key risks that I see that financial institutions, but yet every institution faces in a rapidly changing environment is relevance. Let's talk about relevance in terms of the financial institutions.
Sure. So the thing that makes the financial institution relevant that a lot of institutions don't like is the fact they're so highly regulated and the fact that it's a safe place to go. And I think as people experiment with non-traditional financial organizations and have bad experiences, they're going to gravitate even more back to the traditional financial institution where your money's insured, where there are statutes to protect you from all sorts of illicit activity, because it doesn't take a lot of negative experience for that risk management brain on a personal level to go off. I just lost my paycheck because I put it in a stored value card, now I can't access any of my money, versus if it was at a bank, I wouldn't have that issue. If it was at my credit union, I wouldn't have that issue. And so that behavior is changing. I think that we do need to be very conscious as a community about mergers and acquisitions, because access to financial services is going to become more and more of a challenge as we get more consolidation. But the industry certainly can continue to thrive. It has since the beginning of the nation, and it should continue as we move forward because people need access to secure, stable financial services.
It's a resilient financial institutions that we're looking for, and how do we help them become resilient and even more resilient to face the future?
That's exactly right, and that's what we're about.